And together with Leandro Cipitria, we serve as local chairs of this Congress. And it's our pleasure and our pride to welcome you to Montevideo and to our Universidad de la República. We have ahead of us a Congress that we hope you will find as engaging as we do. Our program features 8 keynote speeches, 8 invited sessions, 14 institutional invited sessions, and 112 contributed sessions. We want to thank our program chairs, Diego Restucia from Universidad of Toronto and Christine Campos from INSPER, for putting together such a rich and stimulating program. And we are also very pleased to have organized the LACEA Mentorship Workshop aimed at providing feedback to 9 PhD candidates from Latin American universities. So we thank all the mentors who will guide these students. And before we begin our conference, we would like to take some minutes for welcome addresses from our organizing institutions. I will first give the floor to Rodrigo Arim, President of Universidad de la República, followed by Marcela Slava, the President of LACEA, and then Sebastián Galliani, Chief Editor of Economía LACEA Journal. And then we will hear Barton Lipman, representing LAMES. And afterwards, I will briefly return to offer some practical information. So I give the floor to Rodrigo Arim, Rector de la Universidad de la República.
If you allow me, I'm going to speak Spanish to welcome you all to our university. Quiero comenzar agradeciendo a la CEA por otorgar el honor de hospedar a esta conferencia en nuestra universidad y en nuestro país. Hace algo más de un año, cuando la posibilidad de la conferencia se realizara en Uruguay en el 2024, un grupo de investigadores de la Facultad de Ciencias Económicas y Administración y de la Facultad de Ciencias Sociales me solicitaron la opinión sobre esa eventualidad. Quiero agradecer a ese cuerpo docente que, pese a los desafíos logísticos y organizativos, asumieron con entusiasmo la postulación y posterior organización de la conferencia. Esos desafíos no son triviales en el contexto de Uruguay y en el contexto de nuestra universidad. Por lo tanto, quiero destacar el éxito de la organización y en ese éxito el trabajo de estos colectivos. Siempre para una universidad, participar y albergar un evento como este constituye un honor y es además el principal encuentro de economía de la región. Convoca a investigadores de nivel internacional, construye redes académicas y es capaz de conglomerar en un espacio físico la producción académica de América Latina y el Caribe y de investigadores provenientes de otras latitudes. Lidiar con el conocimiento avanzado es la esencia de las instituciones académicas. Basta reconocer esta característica para valorar el hecho que la LACEA se desarrolle hoy en Uruguay. Pero nuestra región vive momentos turbulentos. Los movimientos espasmódicos de nuestras economías y nuestras políticas generan una dificultad importante para ubicarnos en un sendero de crecimiento sostenible en el tiempo y superar problemas estructurales tan severos como la desigualdad que aqueja a nuestras sociedades. Estas características socavan el bienestar presente y la posibilidad de proyectar el bienestar futuro, así como también la calidad de la propia convivencia democrática. En tiempos de inestabilidad, las reflexiones académicas sobre distintos aspectos que hacen a nuestras economías son un aporte muy relevante para superar coyunturas difíciles y para encontrar también sendas de superación a los problemas estructurales que mejoren nuestra institucionalidad para construir un mejor futuro para todos. Por el valor intrínseco de la investigación y de las redes internacionales que la sostienen, por su potencial impacto en las políticas públicas, es necesario seguir expandiendo la investigación de calidad en toda la región. Eso es parte de lo que debemos hacer las universidades, en particular las universidades públicas en América Latina y el Caribe. Doy entonces la bienvenida a la Universidad de la República y agradezco en particular a todos a quienes nos visitan de distintas latitudes por hacerse el espacio y el tiempo para concurrir a este evento. Me gustaría terminar con la presentación de un video institucional que muestra algunas de las características de nuestra Universidad de la República. Muchas gracias.
La Universidad de la República celebra sus 175 años en movimiento. Pública, latinoamericana, abierta, autónoma y cogobernada. Productora de investigación de excelencia, motor de la democratización del conocimiento y la innovación. Conectada con la vida política, social y cultural de nuestra sociedad. Comprometida con el desarrollo nacional, la sostenibilidad ambiental, la democracia y los derechos humanos. Conmemoramos nuestra historia con la mirada puesta en el futuro. En este 175 aniversario, reinventemos juntas y juntos más universidad en movimiento al servicio del país.
Well, welcome everybody. It's great to be here. And as Rodrigo was recounting, last year during one of those wonderful grill dinners that they organize here, the conversation came up with the possibility of holding the conference here in Montevideo. La CEA has been seeking to expand the geographical reach of its conferences, and we were amazed at the possibility of organizing this year's conference here in Montevideo. Veronica Amarante's willingness to take on this difficult task and the help of all the faculty here at the two amazing econ departments that they have here at the Facultad de Ciencias Económicas and Administrativas and Facultad de Ciencias Sociales. Their drive has been absolutely fundamental. So a very big thanks to Rodrigo, Veronica, and all the team here. Also to our program chairs, Diego Restucha for La CEA, Christine Pinto for LAMES, and very especially Lorenzo Caliendo, who started as our program chair and unfortunately couldn't join us in the end to the conference, but the initial steps that he took were fundamental. Our warmest regards to Lorenzo. We are very happy with the way that this has developed. We had almost 800 submissions of papers for the conference. There are 500 plus people who have been registered for this conference, so you'll see a lot of people around. There's over 350 papers in contributed sessions that you will be seeing featured at this conference. And there have been other events in these last few days. La CEA's networks, the Network of Inequality and Poverty, the Impact Evaluation Network held events yesterday, pre-conference events. Our Women in Latin America group at La CEA will hold its meeting on Friday. We also had pre-conference events by the World Bank. The Rethinking Innovation in Latin America event was held yesterday, as were the replication games. So there's a lot going around. We are very happy to see all of you engaged here. Let me also take a couple of seconds to thank the institutions without whom this wouldn't have been possible. For La SEA, our institutional members are absolutely crucial, both in terms of providing some support, financial support for this conference and our other events, but also in terms of improving and enriching the program, as you will see throughout the conference. Very special thanks to the IDB, to the World Bank, the Corporación Andina de Fomento, the IMF, the FLAR, el Banco Central de Chile, and the BIS, who have been joining us as institutional members. La Universidad Católica de Uruguay, the Central Bank of Uruguay, they have also joined efforts with the rest of the community here. And I want to very especially highlight this La SEA mentoring workshop that Veronica was mentioning at the beginning. We're making huge efforts to try to help improve the research conducted by students, PhD students here in Latin America, at the universities in Latin America. And you will see featured throughout these 3 days, 9 papers by PhD students who have been mentored. So all of that is going on these 3 days. We're extremely excited and happy to see you all here. Welcome. Let me pass on to our editor-in-chief for Economía, La SEA's journal. There are some exciting changes coming up for the journal, and we wanted to take the opportunity to share those news with you.
Thank you, Marcela. Yes, I started my tenure 2 months ago, and we've been analyzing this new journal, the path of the journal, and how to keep finding its ground. And so essentially, we introduced 3 important things. 2 will be 2 new lectures that will be held, one in La SEA conference and one in the spring online through the La SEA network. One's going to be the Guillermo Calvo lecture, and the other still is unnamed, but will soon be named. And both lectures will invite very recognized scholars to publish on a topic on the journal. The other thing is that looking at the trajectory of the journal, it started basically publishing collections of papers on specific topics that were by invitation. That gave me a lot of visibility to the journal. It was a period in which topics were very interesting. It attracted, again, very important scholars, but that was not sustainable, and we wanted to keep receiving, and the final objective is to keep receiving more and higher quality papers that are submitted by scholars. But we will also reintroduce a bit of the special issues invited papers to get back to some of that relevance and visibility. Finally, we renew the editorial board, and we have a very good editorial board balance, and we are now trying to be very fast in handling all submissions, as most journals have moved to. And hopefully that also will be a factor to consider submitting to our journal.
Let me also remind people that that Economía moved to open access, and it is now published by LSE Press, so you can check out the website. All of the archives are online, so it's not only the new submissions that are open access, but everything is online, so you can check that out. Welcome again. We'll on for 3 very exciting days, and we'll be seeing you around.
Hi, I'm Bart Lipman. I'm the Executive Vice President of the Econometric Society. So I also want to welcome you to the conference. I want to second the many thanks that Marcela just offered, and in the interest of time, won't repeat them all. But I do want to underscore the thanks to our gracious hosts for bringing us into this lovely facility, and the program committees and the local organizers for all the hard work that they did in putting together an excellent program. I note that this is the 45th Latin American meeting of the Econometric Society, which is an exciting milestone. Makes me start thinking about the 50th, but that'll come soon enough. So it's exciting to be here for that. I also want to thank the many partners of the Econometric Society that are crucial. Obviously, first on the list is Lycea, and particularly want to thank Marcela, whose leadership of Lycea has been so critical and who has also worked directly with the Econometric Society in many ways. We're very grateful to her. I also want to thank the BBVA Foundation, which supports the BB Foundation Lecture, which is this year in its 4th year and will be given by Petra Todd. I want to thank the Econometric Society's other sponsors, the Coles Foundation, the European Central Bank, and NYU Abu Dhabi. And finally, almost finally, I want to thank the Regional Standing Committee for the Latin American region, which is, as the name would suggest, is sort of the guiding force of the society in Latin America. And in particular, its leadership, the chair, Ario de Paula, and the secretary, Jean Lafortune, who's I have to give a special thanks to, because this is the last chance we'll have to do that, because her term ends at the end of the year. We're very grateful to her for the hard work she's put in over her term. We'll be welcoming, and my phone went out, Bruno Furman, who will be her replacement and has quite a job following her. And finally, the last thanks is I want to thank all of you for coming and joining us for this wonderful event. Thank you.
Okay, now let me briefly share some practical information with you before we start the Congress. The Congress takes place in 2 buildings. The building where you register, que es the Aulario del Área Social, ASA building, and the building across the street, and please use the traffic light to cross the street, which houses Facultad de Ciencias Económicas y Administración, FUCEA, in your maps. Lunches will be served in the courtyard of the ASA building where you register, and please note that you will need your Congress credential to access the lunch area every day, so don't forget to bring it. We have a group of students supporting the organization, so you can ask them for any help you need. As we said, the Congress has been jointly organized by Facultad de Ciencias Económicas y Administración and Facultad de Ciencias Sociales from UDELAR, and I want to thank the respective deans, Professor Jorge Xavier and Professora Carmen Midaglia, for their support and for their help throughout the process of preparation of the Congress. Also, on behalf of the local organizing committee, we would like to express our gratitude to our local sponsors, Banco Central del Uruguay, Universidad Católica del Uruguay, Banco República del Uruguay, CPA Ferrer Consulting, and PricewaterhouseCoopers. And lastly, I want to extend my very deep thanks to the entire local organizing committee, the secretariat and the staff of Facultad de Ciencias Económicas y Administración, who have worked a lot to bring this Congress to reality. This has been a remarkable team effort, demanding but also fun, and I want to particularly thank those who have been working this month from Instituto de Economía Secretariat, Joaquín Cabrera, Mercedes Morales, Verónica Cabral, and Camila Barreto, Andrea Cavallo, who is serving as Congress Secretary, and our organizing committee members, researchers from our university, Florencia Amabile, Mayra Colache, Mauricio de Rosa, and Luis Frones. So before we conclude, I would like to invite you to join in a round of applause for all the ones who have been working to organize this Congress, and I hope this is an enriching Congress experience. Thank you very much. We have now 2 parallel keynote speeches. One is taking place in this room, and the other one is in the Facultad de Ciencias Económicas in the building of CEA, in front of this building. So let's start our conference. Thank you.
I was trying to locate you. Where were you? everybody. It's a pleasure to be starting this Albert Hirschman lecture of this year. We are extremely happy to have a very esteemed member of our community, Adriana Kugler, who's been part of LASEA for a very long time, but very proud to present her today, to introduce her today as member of the Board of Governors of the Federal Reserve System. Adriana is also a professor on leave of public policy and economics at Georgetown University, and has had different academic positions at different universities, as well as being an MBR research associate and a fellow of the CEPR. Adriana has also had different policy positions as chief economist at the U.S. Department of Labor, serving at the Technical Advisory Committee of the Bureau of Labor Statistics, and more recently, Adriana was the U.S. Executive Director at the World Bank. She's also participated at a series of advisory committees, both in academic associations and government. And of course, we in this circle know her best for her important contributions in labor economics. Adriana was a winner of the John T. Dunlop Outstanding Scholar Award, awarded by the Labor and Employment Relations Associations, and has very important publications, of which many of us know. In her new life, Adriana is now going to talk today about central bank independence. We're eager to hear from her on that position. The session will work as follows. Adriana will hold a presentation, and we'll have then a conversation and a short round of open Q&A. So, Adriana, please, the floor is yours.
Well, thank you. Thank you very much, Marcela. Thank you very much, Marcela, for your generous introduction. And thank you for the opportunity to be here at LASEA at the Albert Hirschman Lecture. I believe I'm the first central banker from the US to address this annual meeting, but I know for sure, and I am very proud to say, that I am the first who is also Latin American. And of course, I have been part of the LASEA Executive Committee, and I have presented papers at many LASEA conferences over the years. So it is just such a pleasure to be back here with so many colleagues and friends, and you know who you are out there. When the US suffered very high inflation beginning in 2021, it was a new and unfamiliar experience for many too young to recall the last time this occurred in the 70s and the 1980s. Of course, very high inflation is not such a distant memory for people from Latin America, and that includes me. Growing up in Colombia, I vividly recall the daily challenges of trying to plan and live with sustained double-digit inflation. And I especially remember the pain it imposed on the most disadvantaged. Gaining control over inflation requires a commitment by society to address the trade-offs and sacrifices that are needed. And it also requires deliberate and principled decision-making by central banks. Central bankers must both formulate their best judgment of the correct policies and also follow through by executing and maintaining those policies. It has been widely recognized that central bank independence is fundamental to achieving good policy and good economic outcomes. It is not sufficient by itself, but it is almost always necessary. Let me start by defining terms. An independent central bank is one that can carry out monetary policy insulated from pressures arising from other parts of government. When there is central bank independence, the role of governments is typically one of representing the public in specifying a mandate for the central bank and holding the central bank accountable by monitoring its performance and appointing its leadership. In this arrangement, the public, through representative government, specifies the overall objectives that central banks should pursue. Some noteworthy examples of central bank mandates include the dual mandate established by the US Congress that requires the Federal Reserve Board and the Federal Open Market Committee, or FOMC, to promote maximum employment and price stability. The European Central Bank's primary mandate of price stability is spelled out in a treaty enacted by the legislatures of its constituent member states. The Central Bank of Brazil, likewise, pursues price stability as its primary objective. In the UK, its parliament has mandated that the Bank of England pursue monetary and financial stability. Similarly, objectives of the central banks of Chile and Uruguay are both to keep inflation low and stable, as well as to foster the stability and efficiency of the financial system. Before we discuss why monetary policy independence can benefit the economy, let me just take a step back and discuss the trade-offs associated with the conduct of monetary policy. Central banks significantly influence prices, interest rates, employment, and income in the economy. So it is natural that sometimes there would be different views on these decisions. For instance, monetary policy actions that promote economic activity and employment can put upward pressure on inflation. Conversely, policies to lower inflation tend to slow economic activity and employment. This trade-off typically means that returning inflation to a specific target when inflation has been allowed to run high may require more restrictive policy and a reduction in demand and higher unemployment. As I pointed out in a speech last spring at Stanford University, however, we have seen this trade-off dissipate over the past couple of years, pointing to the possibility that we have now been for some time in the steep part of the Phillips curve, where inflation can come down without a substantial increase in unemployment. Yet there is a possibility that this trade-off may become more prominent as we move towards that flatter part of the Phillips curve. The economic literature points out that striking a balance in these trade-offs can be difficult for an elected government for various reasons. One reason, highlighted in the literature, is that an elected government may naturally focus on short-term goals of its constituents and may have an incentive to try to lower the unemployment rate in the short run with less concern for long-term effects on inflation and on growth. The literature has labeled this fundamental problem time inconsistency. This incentive may generate undesirable economic cycles, potentially destabilizing prices. And if the public learns over time that the central bank is actually responsive to these incentives to increase inflation to boost employment temporarily, expectations of future inflation would rise, a symptom of the loss of credibility of the monetary policy authority. Governments also may have an incentive to increase inflation to monetize its debts, which becomes effectively smaller as the purchasing power of money declines. Also, if elected officials are responsible for monetary policy decisions, the typical alternation in control of government between different parties may lead to different preferences in the trade-offs between employment and inflation, destabilizing prices and the economy in the long term. In summary, economic research argues that demands on government to address concerns in the short term may result in excessively discretionary policy decisions and do not provide the best incentives for effective monetary policy that promotes the long-term health of the economy. A solution devised by governments and explored in economic research, is to delegate monetary policy to an independent entity, the central bank. By establishing policy mandates in laws or treaties, the government voluntarily constrains itself from suddenly altering policy, and thus, it also discourages public pressure to do so. As in Homer's Odyssey, in which Odysseus asks his crew to tie him to the mast of his ship to avoid being bewitched by the siren songs, policy mandates help central banks avoid being swayed by short-term desires to the detriment of long-term goals. Now that we have discussed the reasons for delegating the authority to conduct monetary policy to an independent entity, we're left with the task of describing how such independence should be designed and implemented in practice. There are two broad categories of central bank independence. The first of these is goal independence, and the second is instrument independence, which I will discuss later. Goal independence refers to the extent to which the central bank is free to define its goals. In particular, the Federal Reserve goals are defined by law, so it is not goal independent. Nevertheless, in spelling out these goals, the law provides the Federal Reserve some degree of independence in defining them in detail. First, let's talk about the extent to which the law has defined the Federal Reserve's monetary policy goals. Unlike some other central banks that target inflation, the FOMC has been handed two co-equal goals: maximum employment and price stability. The committee is not free to pursue one or the other. It must pursue both. And these two sides of the mandate are pretty clear. Maximum employment means, in effect, the lowest unemployment rate that is consistent with the stable prices. The law does not spell out a level of inflation that fulfills the goal of stable prices, but it has traditionally been viewed as low and stable at inflation rate. Mandates limit goal independence, but the form of those mandates can allow some role for the central bank in setting out its goals. The 1977 law in the US defined the FOMC's dual mandate, allowing the FOMC to work out the details. In 2012, the FOMC defined price stability as a longer-run annual inflation rate of 2% as measured by the Commerce Department's estimate of the rate of increase in the personal consumption expenditure, or PCE deflator. Because maximum employment is observed and likely changes over time, it can only be estimated with some uncertainty. Thus, the committee chose not to define it in numerical terms. But the committee participants estimate a related number, the longer run rate of unemployment, which is published every 3 months in the Summary of Economic Projections. Another aspect of independence is instrument independence, which affords central banks flexibility in how to use tools of monetary policy, such as policy interest rates, to achieve its goals. In the case of the Federal Open Market Committee, has allowed it to adopt new ways to achieve its goals, as the financial system has evolved over the decades. This has been particularly important when the economy faced unprecedented challenges, as it did during the 2008 global financial crisis and during the 2020 pandemic. Because of this flexibility, the Federal Reserve Board and the FOMC were able to respond promptly, and as it turns out, very effectively. Across countries and jurisdictions, goal and instrument independence have different dimensions and many variations. In some countries, including India, Brazil, and South Korea, the targets for inflation rates are jointly decided by the central bank and the Ministry of Finance. In contrast, the central banks of Chile, Colombia, Mexico, and Peru, among others, are given authority to choose their own inflation objectives. To understand how governments have come to embrace independence of central banks, it is helpful to review how they have evolved from their origins in the 17th century. Sweden's Riksbank was established by the private sector in 1688 to lend the government funds, and the Bank of England followed in 1694 with a very similar structure and purpose. Other European central banks followed in the 19th century, and a wave of many in the 20th century, including the Federal Reserve. At different times, these central banks made the transition from wholly private to wholly public institutions and became accountable to government. And by the mid-20th century, there was a growing recognition that independence made for a more practically and also ultimately for a more effective central bank. In the US, the moment of truth came in 1951. During World War II, the Federal Reserve had agreed to peg interest rates on Treasury securities in order to assure a smooth funding of the war effort, and after the war, it continued to peg the longer-term Treasury rate. In the early 1950s, inflation soared, but Treasury favored continuing a cap on longer-term interest rates so that debt management costs could continue to be low during the Korean War. After a series of high-level meetings, the Federal Reserve and the Treasury reached an agreement in 1951 that freed the Fed from the obligation to fix interest rates and allowed it to use monetary policy independently to pursue national economic goals. Researchers have analyzed the historical experiences of particular central banks, such as the Federal Reserve, to understand the transition towards central bank independence and how it affects economic performance. In addition, researchers have also developed large cross-country indices measuring the level of central bank independence. The empirical regularity that stands out in many of these studies is the rise in central bank independence starting in the 1980s, with studies analyzing at least 120 countries. Economic research has cited several factors driving this adoption of central bank independence. In the 80s and 90s, emerging economies saw central bank independence as a way to facilitate access to global trade and also to financial markets, which were liberalized precisely during this time period. Another important factor was the experience of developing country debt crisis during this period, which led to demands by creditor banks and international lenders to call for central bank independence. To whatever extent these other factors push governments towards central bank independence, a consensus developed that such an arrangement yielded better economic outcomes. Based on measures of central bank independence, researchers indeed have found a relationship between independence and lower inflation, especially for advanced economies. While the evidence on this negative relationship between independence and inflation has been a bit more elusive in the case of emerging markets and developing economies, or MDES, the economic literature does find a relationship between independence and lower inflation volatility in these countries. Among the reasons I would cite for why it may be more difficult to find a relationship between independence and lower inflation in MDES is that the legal measures of central bank independence, or de jure independence, may not reflect the relationship between the central bank and the government that exists in practice, or de facto independence. In countries where the rule of law is not as strongly embedded in their institutions, there can be wide gaps between the formal legal institutional arrangements and their practical impact. Indeed, alternative measures of independence, such as turnover of central bank governors, point to de facto measures being negatively associated with inflation, especially in emerging markets. Another possible reason is that emerging economies may be more exposed to volatile shocks and government regime changes, leading to greater turnover on central bank leadership and clouding the relationship between central bank independence and inflation. The relationship between central bank independence and lower inflation and inflation volatility is therefore clear. But the connection to faster growth in economic activity is not. On the one hand, the primary reason for central bank independence in most countries with a single mandate is to provide price stability. So the lack of association between monetary policy independence and adverse economic consequences is not that surprising after all. On the other hand, indices of central bank independence may be biased. Most indices of central bank independence tend to penalize the presence of additional mandates or responsibilities beyond price stability. However, a mandate that excludes full employment does not seem optimal, given that the central banker should focus on the consequences of its actions, certainly on long-term growth and economic activity. Research has emphasized complementarities indeed between price stability, economic stability, and financial stability, providing a rationale for these overlapping objectives at many central banks. And in practice, although the recent inflation run-up showcased the commitment of most central banks to fight inflation, it also appears that they have been willing to provide some accommodation after having gained greater confidence that inflation pressures had dissipated. In fact, most central banks have initiated an easing cycle, even with inflation still somewhat above their respective targets, and regardless of the presence or not of an employment goal in their mandates. So if central bank independence does improve inflation outcomes, one question is how it accomplishes it. Let me now turn to an issue I mentioned earlier, credibility. If the central bank is credible about its long-run inflation target, it would be a natural outcome that long-run inflation expectations will tend to be closer to the target than when that credibility is lacking. And a central bank will be more credible if it takes actions that lead the public to be confident that the central bank is actively pursuing its stated goal. It is possible to formalize the channel through which a central bank chooses a long-run inflation target, and the public slowly learns about its commitment to achieving it, thus gradually anchoring long-run expectations. The public observes inflation and economic activity outcomes as well as the central bank actions. For example, changes in the federal funds rate, and it updates its long-run inflation expectations, which in this model coincide with their perception of the long-run target. For instance, a nominal interest rate that is higher than expected, given observed inflation and economic activity and the public's long-run inflation expectations, leads to an updated, lower value of the perceived inflation target. If the central bank's policy actions are consistent with its long-run inflation goal, the public's long-run expectations will gradually settle at the central bank's long-run goal, and this dynamic will anchor inflation expectations to that long-run target. The stock of credibility of a central bank will be reflected in long-run inflation expectations, moving in a relatively narrow range close to the stated inflation goal. Conversely, inconsistent actions will imply that agents will update their long-run expectations higher or lower, depending on the direction of surprises in central bank actions, causing the anchoring of expectations. And to the extent that long-run inflation expectations matter to the dynamics of actual inflation, such as in some Phillips curve models, anchoring of inflation expectations is one of the key elements leading to stable inflation. The model also offers an interpretation and a contrast of the behavior of inflation and inflation expectations during the great inflation of the 1970s and during the post-pandemic period. As inflation rose in the 70s and monetary policy actions failed to rein it in, the Federal Reserve lost credibility, and longer-term expectations of future inflation rose towards the end of the decade. The Federal Reserve indeed struggled for years to rebuild that credibility, resulting in high and volatile inflation. Conversely, in the recent episode, the post-pandemic period, inflation has traveled a long way from its peak, with no deterioration in economic activity and comparatively limited movement in long-run inflation expectations. Credibility is enhanced by transparency and accountability, and I will conclude with a discussion of how these principles are carried out by the Federal Reserve. The Federal Reserve seeks to explain as clearly as possible what it is trying to do in carrying out its dual mandate objectives and how it is trying to do so. Such transparency and accountability are necessary under our democratic system, but it perhaps is particularly important for the Federal Reserve, which has been assigned such an important role in promoting a healthy economy. In addition to conferring legitimacy for decisions, transparency makes monetary policy more effective, as the public better understands our monetary policy reaction function, which informs the public how our decisions are shaped by economic conditions. Monetary policy works in part by trying to influence the public's view of future economic conditions, so it is crucial that these intentions are clearly communicated. The Federal Reserve promotes transparency by issuing a post-meeting statement explaining its decision and then following up 3 weeks later with detailed minutes. Every 3 months, FOMC participants' projections for inflation, unemployment, economic activity, and the likely path of monetary policy are published in the Summary of Economic Projections. The chair conducts press conferences after every FOMC meeting, and both the chair, as well as other FOMC participants, such as myself, explain their reasoning on policy on speeches, news, interviews, and other public appearances. The chair testifies to Congress on monetary policy twice a year, responding to questions from lawmakers. Transcripts of FOMC meetings are published after 5 years. More recently, the Fed has adopted the practice periodically of reviewing its monetary policy strategy, tools, and communication practices, including holding public Fed-licensed sessions around the country to get public input. Transparency is likewise seen in other economies as fundamental to monetary policy independence, which has increasingly been recognized for delivering better policy decisions that are more focused on the long-term health of the economy. Research continues to add to our understanding of the extent of these better outcomes in different economies, and also how independence works in different institutional arrangements. The goal, of course, is more stable economies that deliver broadly rising living standards in Latin America, in the Caribbean, and around the world. Let me now turn to the current economic outlook in the US and how our monetary policy independence has permitted us to be and to get where we are now. The US has seen considerable disinflation while experiencing a cool but resilient labor market. Numbers just released this week show that headline and core PCE inflation have fallen substantially from 7.1% to an estimated 2.3%, and from 5.6% to an estimated 2.8%, respectively, in October. While wage moderation and anchored inflation expectations may allow us to continue to make some progress on inflation, stubborn housing inflation and high inflation in certain goods and services categories may stall our progress in reaching our target. At the same time, labor markets have rebalanced, given greater labor supply from immigration and prime-age workers, and lower demand from restrictive monetary policy. Thus, although the labor market experienced an extended period of low unemployment and job creation these past several years, as well as strong wage growth, the labor market has cooled. It is yet to be seen whether changes in the trend of immigration may take us back to a tighter labor market. The combination of a continued but slowing trend in disinflation and cooling of labor markets means that we need to continue paying attention to both sides of our mandate. If any risks arise that stall or reaccelerate inflation, it would be appropriate to pause our policy rate cuts. But if the labor market slows down suddenly, it would be appropriate to continue gradually cutting the policy rate. Thank you again for inviting me to address you today, and I would be so glad to spend some time with you responding to your questions. Thank you, Marcela.
Well, I also have to thank the organizers for inviting me to chair this session and hold this conversation today. The idea now is to spend a few minutes that we have left to sort of go over some of the points that you raised and discuss them further. Given the audience at this conference, I was wondering, you reviewed a lot of what the research has said about central bank independence, its effects. I was wondering about the challenges that you think that research should address in terms of central bank independence. What has not been said? What do we need to research? What do you invite this audience to look into?
Yeah, this is a great opportunity for researchers out there to help us policymakers out. So thank you for raising that issue. So in preparing this speech, I have to say I was so glad to see so many interesting papers and to review some of the seminal papers even on the theory side on this topic, including Guillermo Calvo's 1977 Econometrica paper. So I'm so glad you have an invited lecture series on his name, because he's really made some seminal contributions. Also Kugler and Prescott from 1977. But I was really impressed with the very extensive literature, empirical literature that has developed in this field. And some of this literature is really very good. It does a really good job and a very meticulous job at measuring central bank independence to these very good indices. That it starts even all the way back to the 1800s. However, as is usual in this literature and in the macro literature, obviously because of measurement issues, but also because of the fact that we can just not randomly make decisions, right? The issue of empirical identification is certainly a challenge. So looking at the causality, right, from independence to the outcomes that I was mentioning, including the level of inflation, volatility of inflation, and certainly economic activity. So I would say that's a challenge. Certainly variation comes at the yearly level, so the temporal variation in these indices is at the yearly level, but many banks don't change their independence or level of independence year to year. And so what researchers have done is that trying to expand this panel cross-sectionally, and they have expanded it to about 120 countries. And that helps because you can then control for country effect, country fixed effects, time fixed effects, even country-specific trends. But certainly that doesn't quite get there to identification. So I guess as a microeconomist myself and somebody who cares deeply about identification, I would urge researchers to try to look for exogenous sources of variation, some ways in which you can identify that causal effect, and try to find some sources of variation, whether political or otherwise, that change independence, the level of independence, and doesn't affect that outcome. Look for natural experiments. In addition, as I mentioned, there is some interesting papers starting to try to get at under what conditions this independence is more or less effective. And I talked about de jure and de facto independence, for example. There are other dimensions that I mentioned that have not yet been explored fully in the literature, so I would urge researchers to try to pursue those. And then I think looking through the channels, I talked about credibility and I talked about expectations. So looking at microdata, for example, trying to look at both consumer and business confidence and expectations as an outcome, looking at big data and microdata could help us to get at the issues of the channels through which independence affects outcomes.
How about other issue that you raised, which was transparency? How do you see research in terms of shedding light on the importance of transparency? And let me put that together with another question. You talked about transparency in terms of its role for monetary policy transmission. You talked about how you guys work towards transparency. Do you also see a connection between transparency and central bank independence? Is transparency also important to sort of foster central bank independence? So a lot on that question, but transparency, research, central bank independence, how do you see those connections?
Yeah, thank you. Thank you for that question. So as we speak, right, this speech is being transmitted to the media, to the public in the US as well. And we view that as being incredibly important because with independence comes the responsibility to certainly provide transparency. And that actually enables for Congress to do proper oversight, and in turn that supports our democratic legitimacy. So that's really important. We definitely try very hard to proactively seek that transparency, to explain to the public, to the media, to legislators how we make our decisions. So I mentioned a few of the ways in which we do that. One of the ways is certainly by giving speeches like this one. I give many speeches around the country, around the world, explaining our thinking about where policy may be going, explaining our analysis of inflation and labor markets and why we're making those decisions. I also take very seriously the fact that we should represent all Americans. And so we engage with the public actually on a regular basis. We have a community advisory council, we have a federal advisory council, we have a community development institutions advisory council. We meet with labor groups, with builders associations, with insurance associations, with banking, with the small businesses, with the whole range of constituents and people out there that may be affected by our policies. So we take it very seriously, and by the same token, I meet with Congress. I had a hearing to get confirmed through the Senate, but my dialogue with Congress didn't stop there. I meet with certain frequency to hear the views of those in Congress, to hear their concerns, and to explain my thinking, as well as on monetary policy. So I think monetary policy obviously is very, very important in terms of providing democratic legitimacy, but it is also really, really important in terms of our monetary policy transmission. So if we explain our thinking, as I mentioned during the speech, what happens is that the public can understand how our policy responds to economic conditions. In essence, it explains to the public our monetary policy reaction function. And they will know exactly why we're going there, and that's what allows us to keep inflation expectations well anchored. So that anchoring of expectations, that credibility, as I said before, is critical for our policy to pass through to prices. And that is why we believe we need to be as clear as possible, communicate with the public, and explain to the public where our decisions are coming from so that they know that our decisions are purely based on the state of the economy and the risks that we see in the economy.
So I want to change gears a little bit to a field I'm more connected and comfortable with, because you and I have shared in the past an interest on productivity. And I'm wondering to what extent your understanding of the role of productivity, of the trends of productivity, the roots of productivity, and also the directions that productivity growth has taken. To what extent those perceptions also shape your view of where the U.S. economy is going to, and therefore, of course, your current role?
Well, I'm so glad you asked about that, Marcela, because we certainly had a good, long, and very productive run working on productivity together. So we were so productive that we worked probably for a little over 10 years, and we produced close to 10 papers. So that's a very productive run, I would say. And we had some really good papers, including looking at business formation, business dynamics, and selection issues. And it's very interesting because that all informs my thinking today. So I recently gave a speech at the European Central Bank where I was discussing how the U.S. has managed, as I mentioned before, to bring down inflation while it's still experiencing a very strong economic outcome relative to its peers, and certainly relative to Europe. So I think there were two things that I mentioned in that speech that come to mind about how we have managed that. Keep disinflation, rapid disinflation, together with a healthy, growing economy and a healthy labor market. And the two things that I mentioned were immigration and productivity. So let me turn to productivity and how I think that helps us. So in the US, there are a number of important factors that affect TFP, total factor productivity. And one thing that we have seen, similarly to what we saw in our work on Colombia at the time, was that there was a lot of business dynamism, and in the post-pandemic period, there was a very high rate of new business formation. And this very high rate of business formation meant that many of those new firms unfortunately closed their doors, but the surviving new firms were incredibly productive and were growing very fast, contributing to high aggregate productivity and also creating competition for incumbent firms. So that increased aggregate productivity as a whole. The second thing about this new business formation in the US is that it has mainly occurred in the tech sector. So places like computer systems design or research and development. And so that's something that actually spreads throughout the economy. It can create very broad-based gains in productivity throughout other sectors as well. A more nascent phenomenon is the rise of AI, as you all know. So in the US, in particular, there has been a lot of adoption on AI, which could be seen as a general purpose technology again. So the business trends and an outlook survey from the census shows that more than 20% of firms in about 15 sectors have already adopted AI. And I would say it's too early to tell, right, how far this adoption has gone. I'm not going to jump and say that this is behind the rise in productivity, but there's some indication that this is actually happening and that this adoption may be faster than, for example, in the 1990s, in previous technological change periods, because the investments have already been made. It's easier to move forward, right? You have need of data centers, other technologies and infrastructure that are needed. So it may be faster than in previous episodes, and it could be potentially very broad-based. It could affect many, many sectors. So there's some potential that this AI could affect, for example, process innovation. Product innovation takes a little longer, but process innovation can be a little faster. And so there could be some potential that this pans out sooner than we think.
It's interesting because in research on productivity, we tend to overlook the inflation impact, potential inflation impact, and that seems like a very fruitful area to look for. So we'll have about 10 minutes. If there are questions from the audience, let me grab a few. 1, 2, 3. But your last answer almost forces me to ask.
Yeah.
Productivity growth is obviously so different in Latin America. Do you have any thoughts about how what you said and what you see in the U.S. compares to Latin America, given that sort of gap?
Yeah, that's a good question. There is certainly a big contrast, and unfortunately, productivity growth in Latin America has been very sluggish now for some time. I would say that it's precisely those differences in TFP growth that can explain a lot of the difference between the US and Latin America. And I think your own work, Marcela, is very telling. You talk and you have looked into the characteristics of those new entrants, and a lot of them are low productivity, small businesses in the informal sector, which really are not sort of the same type of firms that I'm talking about in the US, which are in the tech sector, high productivity firms, right? So I think they don't tend to be these transformational firms, and that could be holding back TFP, certainly in Latin America. But there's also some difference in terms of capital deepening, I think. And in terms of capital deepening, you have big differences in terms of public investment. There has been very weak public investment in Latin America in the last few years, decreasing the quality of infrastructure, which doesn't help us. Private investment has also concentrated in lower productivity sectors, including services sectors, which don't tend to add value. I would say on the brighter side, Latin America has made good inroads on renewable energy and minerals, and if done properly, right, Latin America could add value to the supply chain and then make some inroads in terms of increasing productivity, could explore some of these new sectors that are up and coming and for which there is high demand around the world. So that would be my take in terms of kind of how to overcome that very low productivity and sluggish productivity that we've seen now for some time.
Again, food for thought for those of us working on these issues in terms of the connection with inflation and monetary policy that at least I myself have not explored. So we're going to grab 3 questions at a time. Could you please make the questions concise? There's one here. There was another hand there at the back and here, and I'll take a second round afterwards.
Good morning, Dr. Kugler. My name is Ken Parks. I'm the local correspondent for Bloomberg News. Thank you very much for the very interesting presentation. I have one very concise question, if I may. At the very end of your speech, you say, if the labor market slows down suddenly, it would be appropriate to continue to gradually reduce the policy rate. And can you just be clear, are you saying if there is no sudden slowing of the US labor market, it would not be appropriate to continue to gradually reduce the policy rate? Thank you.
Back.
Carlos Alcaraz, Banco de México. So we are very interested in the U.S. monetary policy for obvious reasons. So 5 years implicit inflation expectations has increased in the last one month or a few weeks from 2.2 to near 2.8. I wonder if you have explanation of this. Of course, there is Donald Trump election win, but if there are other reasons to see this important increase, that's all. Thank you.
Hello, Armando, also from Central Bank of Mexico. So in your presentation, you talked about communication. Do you want me to stop? Or sorry, no? Okay. So you talked about communication. How do you communicate to the public, to the electorate, the importance of central bank independence? Like what actions are you practically taking to communicate the job that you do?
Thanks, and then lastly here, and I'll try to go for a second round afterwards.
Thanks, thanks, Adriana. Great talk. I was wondering, I mean, it's very impressive, I think, how the US was able to bring down inflation post-pandemic from more than 7 to like 2 and something, while at the same time keeping growth high and unemployment low. Yet, these facts regarding the economy seem to diverge quite a bit from perceptions regarding the economy, about like on the part of the public. For example, the crisis of affordability was a central part of the recent election cycle. So I was wondering, how do you think about this gap between realities and perceptions, and what is the role of central banks in trying to close this gap?
So should I answer now?
I think so, otherwise
Yes.
we're going to run out of time.
Okay, so thank you so much for the great question. So let me start with the questions from the Central Bank of Mexico. I would say two things. On transparency, I did mention some of the ways in which we communicate. We have a press conference by the chair. We have speeches, what so-called Fed speak, as the Bloomberg reporter would know, that explains our thinking. We have the CEP, so our economic projections, summary of economic projections, which come out every 3 months. So there are many, many ways in which we do this, and we try to do this as clearly as possible. Obviously, there is a divergence of opinions and a diversity of opinions sometimes within the committee, so it is appropriate that everybody gets out there and expresses their views. So that's the way in which we have done it, and I think judging by inflation expectations, so going to the second question, right, from the Banco de Mexico, I would say inflation expectations have gone back basically to the 2010s. So just to be clear, we're data dependent, but we're not data point dependent. We don't just look at 1 month's data or 1 week's data and overreact to that. We have to look at the whole arc of the data in front of us, the whole broad and diversity of data in front of us, which informs our thinking. But what is clear is that inflation expectations have pretty much moved down together with inflation. So I think that is what is important there. On the question from Bloomberg, I would say, all I'm saying here is that we need to keep paying attention to both sides of our mandate. There may be some risks that come to persistence in inflation, and if that's the case, we may have to pause. If the labor market, on the other hand, cools farther, we may have to think about continuing to pull down our rate. So it's an issue of continuing to pay attention to both. So Ernesto, thank you very much for your question. That's certainly a puzzle, right? We cannot tell the public how to think about their own realities. We need to listen to them. In fact, one of the things, talking about data, right, that we do is we not only look at hard data, but we look at soft data. And we look continuously at perceptions from households, from businesses, from the public, to understand where they see the economy now, where they see the economy going. So it usually gives us a lot of good information in real time. One thing which is true is that prices have gone up, the price level even though inflation has been coming down substantially. And that's probably what many households tend to see, right? Especially, and we know this from research from Alessandro D'Acunto and others, that says that it's those goods that people purchase on a frequent basis that are more salient in people's minds in terms of forming their expectations. So it may be that people look at things such as price of eggs, of bread, right, milk, things that buy on a continuous basis, which continue to be high relative to what they were a few years ago, that is salient. But wages and salaries have gone up more, right? We know that because real wages have been going up. Yet, it may take some time for households, for even businesses to actually come to that realization. So there may be a disconnect there for some period, and people will realize, well, we were actually doing better than we thought, but it's not yet being realized, in the minds of people and households to some level. That could be what's going on, but I cannot tell you what every single person is thinking. I can tell you what I hear from people I interact with on a regular basis.
So if there are other questions, I have a couple of minutes. I can grab a couple more questions. So these two here at the front and right there, please try to make them fast.
Hi, I'm Carlos from the BIS and the Central Bank of Chile. I wanted to ask Adriana what she thinks of the new missions of the central banks, say, regarding climate change, or maybe research with gender-oriented goals.
Hi, I'm Philip Barrett from the IMF. I thought you made a very clear case for the public value of central bank independence. Given that, what do you think central banks have a public obligation to defend that independence when it comes under political threat? And if so, what can they do to protect it?
And then finally, we have two other questions here.
Hi, I'm Nazareno Sanchez from CBF. I have a question related to what you mentioned about the U.S. economy. As you say, two of the most important factors that influenced the resilience in the economy were somehow the AI boom and also the migration trends. And I want to ask you if the Federal Reserve, or if you think about what would have happened if that two factors didn't actually happen in this specific time, so how the US economy would be now. I know that is something that maybe we can analyze in the future, but not today, but just to think about it.
Hello, thank you. My name is Maria Fernanda Rossi from Universidad de la República. And my question goes to operational research in monetary policy. If you think, it has received so little attention so far. And do you think it would...
Sorry, can you repeat that? There has been...
It has received so little attention, operational monetary policy research. And do you think it will foster, it could foster credibility and transparency if, in the case it will grow? Do you think it is an issue that we lack so far?
So thank you for that question. Maybe I'll start with your question. I think there is a growing research, right, on that operational side, I would say, in particular, in terms of the transmission mechanism of monetary policy. There has been a lot done. So I would say, depending obviously on different central banks that may play more or less of a role, but I know at the Federal Reserve Board, there's some very good research being done on that side. And I think it is very important, right? Because at the end, it's not just a theoretical concept, but it's something that needs to work in practice. So to that issue, yes. On the issue of, in some sense, what would have been the scenario with or without different forces that we think have helped us so far, yes, we do analysis on that. So that has been helpful. It's always difficult, as we mentioned before, to parse out how much is due to this, how much is due to that, but we can understand the channels as well through which, productivity, immigration, other aspects, including credibility and expectations, have helped us to continue bringing down inflation while keeping a healthy economy. So we do that indeed. The question from the IMF, I would say, we're committed to our mandate. That's the way we should be doing things. We are asked by Congress to commit to this dual mandate, to be objective, to be independent, to be isolated from outside forces in making our decisions, to make decisions in the best possible way for the public, for all of the American public, and that's what we do every day. So that's what we have to do, and we have to stick to our mandate, to what we've been asked to do by Congress. That's essentially the best way to proceed and to continue doing things the same way we have been. So thank you.
Well, I'm afraid we're now out of time, but let me also congratulate the organizers for having brought you here.
Thank you.
And chosen you for the Albert Hirschman Lecture this year. I think this has been extremely interesting and very aligned with LASEA's particular interest among the academic associations to foster discussion with policy. So let me follow the organizers' lead to just tell you, we were given these leaflets. Then it turns out inside them there are maps of the rooms. So the two buildings are mapped inside these leaflets. There is a coffee break going on right now till 10:30, and then contributed sessions start at 10:30. The maps will guide us to that. There is a PDF of the program that can be downloaded if you want to locate particular sessions in an easier way. Thank you very much. Thank you, Adriana,
Thank you.
and I'll see you in contributed.
Thank you.